Greetings, I'm Nick Shermans, president of Pure Portfolios. Today we're going to shoot a short video on all of the turmoil around the presidential election and its potential impact on markets. As you can see from our title, we think the two don't mix. Politics are great. We encourage people to pay attention. We want them to be patriotic and vote. However, when it starts to leak into your investment portfolio, that could be a potential problem. Zooming out, we can point to evidence. We can point that politics and investing don't mix and back it up with market returns and the impact of presidential elections on markets, which is not really a clear line, but people just can't help themselves. We're inundated with headlines and water cooler talk about narratives, and it creates anxiety. Every now and again, it's important to zoom out and look at the evidence, and hopefully this allows us to stick to our long-term investment plan and not derail it with nonsensical emotion. So let's get into the slides. I've got 3 slides here. So it's okay to be anxious. Like I said, this is a charged up election cycle. Most election cycles, it feels like the most important one ever. And I saw a recent study by Nationwide, and it said something like 45% of Americans believe that the election outcome has a greater impact on their retirement success than investment returns. And something like 25% thought their retirement plans would be derailed if their preferred candidate did not get elected to office. Now, that's a dangerous train of thought. And I think when you reconcile the headlines and how people are feeling versus what's actually happening in financial markets, there couldn't be a greater gap. So what I have here is the daily returns of the S&P 500 by year. And it starts with 2020. Of course, this was a COVID year. And you can see how wide the range of returns was. That was an extremely volatile year. So the wider these dots are, the more crazy stock prices were. Then we had a great year in 2021. You see not a lot of range here as far as a negative return. So here on the left side is negative returns. Here on the upside is positive returns. And keep in mind, this is daily by year. So the tighter the dots, the tighter the cluster, the less volatile a calendar year. And you can see 2024, very, very tight. And the one outlier, if you want to call it that we got was on the upside. This has been an extremely docile year in financial markets. I think we're 350 plus days and counting without a 2% drawdown in the S&P. We've hit something like 38 or 39 all-time highs. And again, when I talk to people, they think the market is extremely volatile, and they mention the election. And when you look at what's actually happening, that couldn't be farther than the truth. Okay, so I know recently we've had some unprecedented events. Attempted assassination of a former president. We have the incumbent who was going to run for re-election drop out of the race. And I know that can feel daunting, like it's never happened before, but something loosely similar happened in 1968. And I won't go through what exactly happened, but you can see we had Lyndon B. Johnson drop out. We had an assassination of a presidential candidate, and then you can see the election commenced. But the S&P was actually up on the year, a total return of about 11%. Despite all of these scary, unprecedented headlines, the market shrugged that off. And that's not uncommon. People tend to overstate the impact of an election or a sitting president. We've pointed in past blogs that S&P returns are actually quite positive in election years. And I believe 2024, up to this point, today is July 24th, has seen the best performance for the S&P in an election year. So again, pretty good returns for the S&P, actually the best ever in an election year, and the volatility is essentially non-existent, which means the market is paying attention to the election in the short term, takes a lot of headspace, takes a lot of headlines, it dominates the water cooler talk. But when you look at what's actually happening, the S&P has shrugged off all the noise, and it's more focused on earnings, the direction of inflation, the Fed's interest rate path. Those things are much more important to investors than the headlines. Finally, what this is essentially showing, post-1953, the red bar here on the left is if you invested $1,000 only when a Republican was in office. So since 1953, I believe this is as of April 2024 close. So a pretty good timeline of data here. If you invested $1,000 only when a Republican was president, so that means you would sell when a Democrat is elected to the White House and then get reinvested when a Republican is back in, you would have $27,000. If you only invested when a Democrat was in office, you would have roughly $52,000. And if you didn't pay attention to who was in office and you just stayed invested with that same $1,000, you would have $1.43 million, okay? So mixing investing in politics really is a slippery slope. I know it's easy to get sucked into the vortex. Again, we want people to be passionate and vote for their candidate, but when it starts to impact your money decisions, that's where it can be very costly, and the evidence certainly backs that up. So if you like this type of content, feel free to give us a like, a subscribe. If you have any questions, shoot us a note at insight@peerportfolios.com. Thanks for watching.